All right. Well, welcome everybody to a very exciting Alternative Investing Mastery Series session. That's a mouthful. We got a great turnout here today. We're going to talk about something that we probably don't talk about enough. We talk about all different kinds of assets. We talk about really weird and quirky ones like life settlements or cannabis or timberland or pilot education or all kinds of different investments. But we don't necessarily talk about how to understand what investment offering documents are. What are operating agreements? What are private placement memorandums? What are slide decks and more? And we have a series of people out there whom are on your side. They're hired by the syndication attorneys of the world, but their job is to make sure that they are making sure these they're hired by operators like myself out there, but their job is to make sure that these operators are falling within the lines of how you can legally raise capital and make sure they fully disclose all the risks and that everything is spelled out in a way where it's safe for you and them to engage. And so they're here today to talk about these things. And I think it's going to be really great. Make sure you drop all your questions into the chat as you go through it, because I have paid hundreds of thousands of dollars over the course of the 20 plus some partnerships I have been involved with as a GP and LP, and to individuals just like this. And they have charged upwards of $500 or $600 an hour for that time. So just keep in mind, you have an incredible resource here, very unique resource here. So make sure that you save up those questions and we get those over and we get those done. We're talking about explaining investment offering documents, OAs, PPMs, and slide decks, what the investment documents are and what each of them are actually telling you. The big red flags to look out for in risk disclosures, fees, investor protections, how to understand return projections, preferred returns, waterfalls, etc. Things like that. You know, who gets paid and when and how. What capital calls are, what they really mean, how they can happen, whatever other question you have, drop it into the chat. We usually have 40 to 60 questions in these kinds of events, if not more. I'm expecting to be a lot more, guys, because I'm sure if you've read 100 plus pages of documentation on these deals, you had to have at least each of you 100 questions. So we'll get to as many of those as we can. If you're new to this series, this is Passive Investing Mastery. It's my company's approach, blue ocean approach to getting all the different kinds of alternative investment strategies out there. So normally we've had over 60 different kinds of alternative strategies, whether it be sponsors or investment or asset classes, or ways to do it with asset protection, wealth efficiency, tax efficiency, and how to do estate planning, things like that, things that vehicles and strategies so you can do it effectively and safely, as well as where to go invest in alts. And so we do these on a bi-weekly basis. It's kind of my approach at giving back to the world and saying, hey, look, here's every other way you can invest outside of the stock market and outside of our deals. We sponsor here at Passive Investing Mastery because we also provide investments as well. And our goal is to get you mastery in the art of passive alternative investing. Great to see some comments here coming in. Please keep them rolling in. We also have educational webinars and books. If you want a book, let us know. Happy to get you a signed copy. Our next event, June 10th, from managing hedge funds to financing medical receivables, we're going to learn the backstory of our partners in our medical receivables fund that we've launched. Really excited. Since 2009, Alex and Leon have originated over $300 million in medical receivables. They came from an incredible background. We'll learn about their upbringing and education, how they survived 2009. They, like me, lost a lot. I was in high tech and real estate. They were in Wall Street. So we have two different experiences on how bad that was. Why they chose healthcare coming out of 2009? What were the reasons why? Resilience of the asset class, and how passive investors should look towards succeeding right now in this economy and moving forward with their choices of passive investments. If you have any ideas and you're out there like, hey, look, I know of this quirky guy. I just got a message from somebody saying, hey, there's this guy who's doing patent investments that you can invest to invest in patent enforcement. I'm like, interesting. There's so many different asset classes out there, whether it's a strategy, a technique, an estate, or an asset protection, or a sponsor. Let us know. We will put a panel together. We basically 100% of the time people have asked, except for oil and gas. Actually, we have put together panels for the requests that have been made. We also do a disclaimer. This is kind of an interesting one because our disclaimer usually is this is an informational presentation. for education and informational purposes only. We do not endorse, recommend, or condone any specific investment opportunities or sponsors mentioned, nor have we conducted due diligence on them. We are not financial advisors, attorneys, or CPAs. Now, there may be some attorneys on this call. They're not your attorneys, though. Okay, they are attorneys, but they are not engaged by you yet. They could be. They could very well be your attorneys, but just make sure that you know this is not legal advice. So nothing discussed should be considered legal, financial, or tax advice. Always conduct your own due diligence and consult with your team of qualified professionals before making an investment decision. Attorneys, give me a thumbs up if I have an okay disclaimer for this. Yeah, I think Julian's gonna, okay, great. All right, I got a thumbs up. All right, little free advice there. Seth Bradley, welcome. Glad to have you. Securities attorney with 10 plus years advising sponsors and fund managers on compliant capital raises, has helped structure and close billions of dollars in private securities and commercial real estate transactions. Founding partner at Raise Law, focused on syndication funds and fund of fund structures. He's also the chief legal officer at TriVest, a really cool platform that we're potentially looking at partnering with, and I'm waiting for him to give me feedback on the side letters I sent him last week. Bethany LaFlam, CEO of Premier Law Group and a real estate attorney, syndication attorney focused on SEC compliance, helps sponsors structure offerings, navigate regulations, and scale without compliance headaches. Known for a practical, business-minded approach that protects deals while keeping execution moving. Awesome. Appreciate you coming. And Jillian Sidoti, capital raising strategist with a legal background, co-founded and sold crowdfunding lawyers, has built and sold multiple seven-figure businesses and helped raise millions of dollars for real estate deals. Really impressive. Partner of Investor Attraction Academy, teaching ethical, repeatable strategies for attracting high net worth investors. And then there's myself, the host here, Patrick Grimes. I was a machine design, automation, robotics engineer. Went into real estate, lost everything in 2009, got my way back in through single family and then apartment buildings, did some energy, and now we do a lot of legal and medical, as well as some commercial real estate, debt and equity. Write for Forbes, got a bunch of different things going on. So let's go back from the top here. We'll go alphabetical order. First Seth, then Bethany and Jillian. Why are you excited to be here today to talk about investment offering docs?
Yeah, always excited to talk about investment offering docs. We'll try to keep it exciting. Sometimes this can get a little bit get a little bit in the weeds when we talk about compliance and regulations and the SEC, but we'll try to keep it interesting today. Just keep in mind, this is an expensive call, guys. And we got 3 securities attorneys on here. This is a really expensive call, so enjoy it.
Very good. I'm super excited because I think the more educated our community as a whole is, and by our community, I mean real estate investors, real estate syndicators, and operators, the more educated we are as a whole, the more wealth we can create, and also the better our entire community does. So it's always exciting to me. I know it can feel overwhelming, but I've heard everybody on here speak, so I think we'll try to keep it kind of fun for you when we're approaching happy hour.
All right. Well, happy hour in Hawaii is around noon, I guess. So
I'm not judging, Patrick.
All right. So, audience, thank you, Lena, Seb, Jim, Elijah, Barry, Brian. Keep the comments coming. Start with, make sure you drop it into the chat. Josh, glad to have you. Keep the comments coming. I will layer them in as best as I can as we go through the discussion. If we don't get to it, it's because maybe I missed it or maybe I didn't get it right. Don't let me off the hook, drop it back in. If we don't get to it during the session, we'll get to it after the 45-minute get to know them, how can you reach them session, and then we'll go to the Q&A. We'll do their best to get, I'll twist their arm as best I can to keep them on, as long as I don't get an invoice after this, to get all your questions answered. So let's start with just, hey, high level. This is about what investment documents are. And for the most part, we're talking about securities offerings, or Reg D, 506C, these kinds of complex things. So we've specifically kind of framed this up as syndication documents, right? Because there's lots of different kinds of investments out there. But so when you're talking about the syndication documents out there, what does that mean? What are the investment documents for those? Julian, what are those key documents that investors should expect in a syndication? And let's hear from the rest of the group.
Oh, well, honestly, the story of the investment is the private placement memorandum, right? So that's what's telling you how the company, like what the story of the company is, what they're going to invest in, what they're going to go after, who the management company is. But I honestly think that a lot of passive investors, what they miss is that that's not the controlling document. That tells us a story, but the controlling document is the operating agreement. And so one thing I always tell passive investors to look for is, does that private placement memorandum match what the operating agreement is holding you accountable for? What is it really holding the management and the members and everyone accountable for? Because it's not the private placement memorandum. So it's really important to make sure that that private placement memorandum, which tells the story, the operating agreement, which is the legal binding document, and you're going to sign the subscription agreement, they all work together, have the same terms, have the same conditions, and all those good things, all that legalese matches.
I'd like to add to that, if I could, as important as that, because there's times when, believe it or not, they don't all match, is whatever your pitch deck, your webinar, your social media post, whatever it is you're telling the world, you're giving them, also better match what the legal things they're signing is. Otherwise, it looks a lot like fraud, right?
Yeah.
Yeah, that's exactly right. I totally agree. I mean, it's got to tell a congruent story, right? Everything from your social media posts to your pitch deck, to your phone conversations that you have between the investor and the sponsor, to the operating agreement and the PPM, it all needs to tell the same story. And the more that it doesn't tell the right story, the same exact story, you start to lose confidence in that lead sponsor, right? You start to say, well, if the PPM doesn't match the OA or the operating agreement, then that's a problem. And then take it a step further. If the pitch deck doesn't match the PPM, man, that's a problem. Like if they've got numbers mixed up and they're trying to refer to the same thing, but it's different. I mean, that's a yellow flag. I wouldn't call it a red flag quite yet, but you definitely need to dig in a little bit deeper.
Yeah, I want to say to what Seth's saying about it being a yellow flag and not quite a red flag, because a lot of times it's bad legal work, right? Not, all three of us practice securities law. None of us ever did that, but like, but don't throw the baby out with the bathwater. If you're seeing that the OA doesn't match the private placement memorandum, question it, right? But question it in good faith. Is what I want to say, because you never know what the sponsor's not a lawyer, right? So you don't know what the sponsor might have missed in their own documents. Is that a yellow flag? Absolutely. I would even call it orange, but I don't want you to also think, well, if they must be trying to hide something, they're being dishonest. I think the dishonesty, most of the time, if there's dishonesty, it's lying in with something you mentioned, which was the pitch deck. If you're going to look for dishonesties, it's usually there.
Yeah, and something to remember too is, most of these operators are entrepreneurs, which means they're flying by the seat of their pants, and we're just trying to like hold on to them and so they're making changes as fast as they can think of them, and they don't always realize it's that important to relay that to their lawyer to make sure everything matches. They think, oh, it's no big deal, I'm just going to change this one thing, not realizing it triggers 5 other things and all the other documents. And so it might just be that they're moving so fast that they're pivoting if they need to, and they didn't think to tell their lawyer too. Mm-hmm. Again, still a yellow flag, because they got to be communicating with their advisors.
I love what I'm hearing, because we started out with like, hey, look, the operating agreement, that is a controlling document, because that's where you're contractually obligated, right? And right. So these documents can get massive. Why? Because you have to have the disclosures in the private placement memorandum, but then you have to have it again in the operating agreement, and it is just incredible. Like these documents can just get super bloated, and that's just really tough. I've waded through, as you guys have thousands of pages of these things, and it's just really tough to keep everything in alignment. And then there's this concept of, hey, how was the marketing? How was the marketing align? Were there false promises, right? And were there hooks that didn't quite, even at the top of the funnel and the Facebook ad that they got. And then when they got into the webinar and then they said, well, it didn't quite say that was a guarantee, or it didn't quite say that this was the potential return, or this was the risk. And then I found like that there is like this concept of deceptive marketing practice where in securities law, they don't allow you to kind of put a hook in an ad that kind of gets you in the door and then change it up when you're in the door. You've really got to have that contingency, that congruency without discontinuities all the way through to the documents.
Absolutely.
So let's break them down, I guess, like one at a time. So what I kind of think of it as the slide deck. And then I usually have people read the private placement memorandum. It's more readable, and then I have them look at the operating agreement. Sometimes it's much more difficult to ingest. That's usually the order. Maybe that's wrong, but that's what I do. It's a little bit different than how Jillian said, go for the operating agreement at the beginning. But let's start with the pitch deck. What makes up a good pitch deck? What are the things that people should watch out for, look for that are good, and the red, orange, yellow, green of pitch decks?
So, this is where I live right now, is I live in the pitch deck world, because that's what I'm doing. I create automations and pitch decks for people who are out there raising capital. So, I understand. I want to be clear on my answer, that this can rub two ways. One, the sponsor, what should be in their pitch deck, and two, passive investor, what should be in the pitch deck, right? And we're all talking to passive investors tonight, so I'll be mindful of that. But again, I said the PPM's like a story of the investment. It's the legal story, right? Now, the pitch deck is the story, the colloquial story, the story we want to hear, like a bedtime story. Okay, maybe not that severe, but the thing that always grinds my gears about bad pitch decks, from a passive investor's point of view, is when the sponsor or the management tries to hide something deliberately. And to be clear, I'll give an example. And this is what you guys want to be looking out for as a passive investor. Is I was on a pitch one night for an apartment building, and these guys on this pitch kept repeating, and we're going to put in, we'll just say $400,000 of our own money. We're going to put in $400,000 of our own money. They couldn't say it enough. It's like, okay, we get it. You're going to put $400,000 of your own money in. Well, fast forward ahead to one slide that they skipped over really fast, talked about the use of proceeds. And in that use of proceeds was a line of management fees, due diligence fees. And it just so happened to be $400,000. And I caught it, and I called them on it. I said, you guys said you're putting in $400,000 of your own money, right? And they said, yeah. I said, would that be the due diligence fee that you're earning? That's not your money. That's the investor's money that you're going to use to put back in. It's fine if that's what you're going to do, but don't make it sound like, oh, we're these virtuous people who are writing checks for $400,000, because that is not what's happening. Your investors are giving you $10 million, and you're taking in $400,000 of that and calling it your piece of the pie. That kind of stuff is the stuff you really want to be. Anything where they're telling you over and over and over again, like this is like this amazing benefit and feature, question it immediatly.
Seth, Bethany, what are the things that are the, red, yellow, orange, red, orange, you guys, whatever you want to call it, give me those things, that not all the negatives, but also the positive. What are the good, the bad, the ugly about the offering memorandum, the slide decks out there?
Well, I like to see how the underwriting is done, and I like to see all the way down below the NOI. After fees come out, after distributions are made, what are they thinking people are getting paid, so that it shows a full picture on the projections, right? Instead of just, I've seen posts that are be like, how do you feel about 3xing your money in 5? Great, is that what you're gonna do? Because I don't know, right? And I actually saw one time that said, how do you feel about 38% return, annualized returns? I'm like, awesome, but you're not gonna do that in a fund. So I'm not sure why you said that. So I like to see all the way down, like where they think they're getting the returns, but also a sample investment. And then tell me what your assumptions are. With the more transparency, and the decks get a little bit longer, they get a little bit heavier, but the more transparency, the better. If I'm investing passively, I want to know all the things, and I don't want to have to dig for it. Just give it to me, because if I feel like I have to dig, I'll just go somewhere else where they're just going to hand it to me. Kind of like what Jillian was saying. Like, if you're going to put your fees back in, just say that. That's fine, because a lot of people don't realize this, but as an operator, you can do almost anything you want to as long as you tell your investors you're going to do it and they're cool with it. So just tell them, right? So I think that, one is, if full transparency is a green flag. And even if it's like, hey, one of our deals did not go so great, but here's what we learned. Okay.
Preach, girl, preach.
I know. I'll stop and let somebody talk, because I am.
I agree with everything you're saying.
Yeah, building off of that, I was going to say track record or example deals, right? And you kind of touched on that, Bethany. It's, sometimes you'll see an example deal or two that has its own slide, and you're like, oh, we returned these returns to investors. We had a 3.5x equity multiple. We exited in 2.5 years. And you see a couple of good deals, but what about the bad deals? That's actually not allowed. So from the sponsor perspective or the passive investor perspective, this is something to look out for. If they're only showing you good deals and there's not another slide that shows at least kind of a summary of all of the deals, that's a yellow flag for sure, if not orange flag. I don't know where we're going to go with the color shading, but you certainly need to disclose the bad deals or the okay deals if you're going to disclose the good deals. So if you see only a couple of slides on there that have good deals, ask them, well, where are the rest of them? Is there another slide? Is there an appendix or something somewhere that shows me the full track record of your history, or not? Or show me what that looks like.
There's a couple questions here. What could be missing from the pitch deck, or it could be a red flag from Sean. Barry's saying, hey, what happens if the operator says, oh, it doesn't really matter what's in the pitch deck. It matters what's in the operating agreement.
That's right.
Then why do we have a pitch deck?
I think we just said two opposite things, Bethany. I'll clarify. We
don't bother though, because it does look like a lie. Yes, the PPM is going to control, but it looks shadier if you have something that's different, that's like drawing people in, and then you're going to flip the script on them when they go to sign something.
Yeah, but I'm gonna push back on you for a second, because fundamentally I agree with you what you're saying, but technically I want to just take a step back for a second. Your operating agreement and your private placement memorandum are sometimes these big monstrous documents that have legalese in them and explain everything. In your pitch deck, you're not going to say, well, I was sued back in 92 and right? Like, you're not going to go into all that. Not just for that reason, because it doesn't make for a good pitch, but also because I'm very cognizant when I'm doing pitches and putting them together, I'm very cognizant of the eyes of the potential investor glazing over, right?
Yeah.
Wasting their time, spending an hour talking about every single detail. One thing I tell my clients is a TED Talk is 17 minutes. Be a TED Talk. You don't need to drag on for 45 minutes about all the bells and whistles of your deal. If they're really interested after your pitch, they can read all the legal documents. So fundamentally, yes, you're right. Like, don't try to hide anything. But at the same time, we're not looking to, we got to be precious with people's time.
To be honest, when we started in this business, I was able to get people on for a webinar, and we would see them drop like around that, 38-minute, 40-minute mark. Now you don't really have that. You only have 10 or 20 minutes. I think the world is changing of
not
webinars.
Tonight, Patrick. Everybody's staying till minute 61.
Well, that's it. Well, webinars, investors really want it down to 5 or 10 minutes, and it is very difficult to fully disclose the details of an investment, the risks, the disclosure, everything you need, and the waterfalls, the returns in that time frame. So we've gotten to the point now where we'll do the webinar, And then we break it up into little sections, and then we'll put, here's the intro to the sponsor, right? Here's the intro to the asset class, and then here's the returns, right? And we break it into like a choose your own journey. Because I'm constantly fielding complaints about a 45-minute webinar. I mean, how do you even handle that? How do you get it that small? I'm an engineer. I'm a detail guy. I struggle.
I'll tell you. You just use a formula. And the formula is why, what, how, what if what. That's it. Like, so everybody write that down. Why, what, how, what if what. Why are we doing this? What are we doing? How are we going to do it? What if you could be involved, building the dream for the particular investor? And that's that what if part is where you start talking about returns. You don't start with returns. So you start, why are we investing? What are we investing in? How are we going to do it? You repeat those three, why, what, how, until you've exhausted that enough to give them enough information to make an informed investment decision or to get the PPM. And then you tell them, what if this is what we're paying for returns. This is how we're going to pay your returns. This is our minimum investment. You don't start off with, hey, everybody, this is our 15% return on investment opportunity. Let's get going on this presentation. That comes at that what if part. And then what if what do they need to do next in order to invest? They need to read the PPM. They need to read the operating agreement. They need to attest that they're an accredited investor. They need to sign up on the portal, whatever it is that they need to do next. So, yeah.
I've actually been telling my clients to see if they can get it down to 30 minutes, which would be an incredible thing to do. Jillian, have you seen that? Because you advise on pitch decks, and sounds like
all
the
the
pitch deck
time
just goes right along with the webinar. So I'm wondering if you're seeing that. We're trying to get it down to 30 minutes. It gets people really excited, ready to go, and then you leave them hanging a little bit, right? It feels like
all the time. I do it constantly. I do it constantly. And I was watching. It was funny because I was watching a criminal defense attorney today talk about when someone's lying, which was interesting. And it's not always a tell, but it can be a tell when somebody talks about something in vivid detail, like they give you details that don't matter, for example. So I also think about that. Are you giving too many details all at once? Are they going to, and what are they going to remember? I have so many different ways of thinking about this. There's this amazing book called, and this is a good book for anybody to read, not just if you're doing investments. It's called The Most Important Graph in the World. And it's by Tony Buzan. It's not in print anymore. I don't know if you can get it on Amazon, but it changed the way I think about telling a story, that the investors are only going to remember the primacy effect, which is the first thing you tell them, the recency effect, which is the last thing you tell them, and a von Restorff in the middle, which makes them think about things differently. And then you're going to make connections throughout. So I would tell you guys that, if you really want to know about from a perspective of how to present, that's what I would do. Now, but you guys are passive investors. So what you really need to be looking for, are they talking fast? Are they giving you too many details that don't matter? Are they making a big deal out of what seems like shouldn't be a big deal out of something? Those are the tells to me that it's not a good investment opportunity. And are they excited about things that seem strange to you? Like I once had a guy who was pitching me about a multifamily opportunity, and they were so excited that the multifamily building was next to a Frito-Lay factory. And I'm like, why? Why are we excited about that? But they wouldn't stop talking about it. So I don't know, stuff like that.
So we're talking about pitch decks a little bit, and I mean, there's a lot of questions that are kind of getting in here on some specifics. Eileen, we'll probably get to some of these ones that are about like deal specific. What if that? What if this? What if that kind of stuff? When we get to the Q&A. But let's dive into the more difficult ones, because obviously with the operating agreement or the offering memorandum, the slide deck, they made that really easy. We put together these beautiful things, and then we talk through it, and we practice and rehearse. And then you get this PPM and this OA, and and in there's just in the PPM, an overwhelming number of risk factors. There's all this information about fees, information about conflicts with the manager, and then there's stuff about the investment strategy, right? And then separately, there's an operating agreement. It's got distributions, waterfall, management authority, lockups, all this stuff. How to start with the PPM next, because that's my order. So the PPM, how should investors navigate something like that? I mean, it's like we're talking like 100 pages oftentimes. How do you these passive investors, how should they navigate reading a PPM?
With wine.
What should they be for? Sorry?
With wine.
I like you.
I'm sorry.
Pour a glass, have a seat. Honestly, I tell people to start with the definitions, right? Because we take complex things and we put them in that, we define them so that we can then use them throughout. People skip that a lot of time. They're like, oh, whatever, I'll just go to the thing. And I first say, don't skip the definitions. But the other thing is, don't skip the fees. It's you got to know how your operators are getting paid, and I think for a number of reasons you need to know how they're getting paid. One is you want to know where all the money's going and what their upside is, but two, you want to make sure too that they have an incentive to keep showing up even when it's tough as well, which might be not a popular opinion, but I think that's important because things got tough the past couple of years, and a lot of folks stopped showing up because they weren't really motivated to do that because they thought it was a good idea to say, we're better than everybody else because we're not taking fees. We're better than everyone else because we're giving you, this one's going to be a loss leader. Don't worry, we'll make it up later. And then, things start getting tough and they're like, yeah, I have to go to my job now, right? Because I need to make some money. And then they're not paying attention to the asset. So I think it's important that there's a good balance between, and not just what are they taking out of investor fees, but what's all the compensation? Are they the management company? Are they the broker? Are they making decisions that make sense? And do they tell you about it? Right. So I think it's important to look at what the management has to win or lose in these deals.
Bethany, I want to just say to that, I personally, as a passive investor myself, never invest in a deal where the management isn't getting paid because I know that's not going to end well.
Exactly. I know. And it sounds counterintuitive at the beginning, right?
Yeah.
When you're like,
there's got to be alignment. There's got to be alignment, right? Like if there's no motivation, there's no incentive for the managers to continue doing a good job, then yeah, they might be excited at the beginning of the deal, but 5 years later, are they still going to be excited? Think about your businesses and what you've done over the last 5 years that you've stuck with. A lot of stuff has changed. Your enthusiasm has changed. Everything has changed, right? So it's the same thing for them. They need to be financially incentivized to stay with it, stay in it, and produce.
Now, also with fees, because if the promote's not paying out, they disappear. I think I'm in like 20 plus. I'm exposed to like 4,000 apartment units, and I've invested with these very large operators that are supposedly $100 million wealthy family offices. Well, guess what? They personally guaranteed dozens of loans that were many X the times of their wealth, and a large portion of those fell apart. And where'd they go? Right? And this is it. If this is not something that can support them, that this is exactly what happened. It's hard to get a hold of them. You can't even get responses. We had one of them was oust. A vote had to happen, and that person who was a very large, supposedly wealthy guy, had to be outed because we wouldn't even show up for the job. So that's happened to us. So we got the fees, the conflicts. Let's see. There's risk factors. How do people navigate those risk factors? I mean, it's just literally 100 ways that you can lose. It's overwhelming.
Yeah, there's a lot. I mean, I would say, just going back to finish off what we were talking about before, because the PPM is overwhelming for people, right? Like if you haven't seen one before, or it's your first or second or third investment, and these things they can be 100 pages. All legal documents tend to get longer. They don't get shorter because people get sued, issues come up, you add more provisions, and they just get longer and longer and longer over time. And PPM is the same way. And, a good place to start is really just the summary, right? Like almost all PPMs have a summary up front of some sort that summarize the terms. And then you'll hear people complain because they're like, why is this in here 3 different times? You've got it in the summary, and then you've got it in the body, then you've got it again hopefully it reiterates exactly what it said in the operating agreement as well. They're like, it's the same thing over and over again. Well, because it means different things, you should go with the summary first, just to get your feet wet, to get a good feeling over what the deal is, before you probably want to navigate to the risk section, because that one is probably going to be pretty long. And, depending on how well or how well not it's written, there could be a lot of things that apply to this particular deal. Some things that are just really general and don't apply. You might see hurricane risks, even though the deal's in New York, and things like that just kind of are layovers from a template. But, those risks are, that's the part that tends to get longer and longer and longer, because as things come up, lawyers add more and more risk disclosures, and they tend to just leave them in there instead of taking them out.
But you get to ask questions too. If you look at this, you're like, oh my God, I can't with this. If it starts to trigger a question, ask. And if the operator doesn't want to answer your questions, maybe pass on it.
I love that comment, actually. I right before this, I was on with a very smart couple that spent an entire hour asking questions about our medical receivables portfolio. And it was everything from the offering memorandum, the operating agreement, subscription agreement, to the webinar. And they asked for my due diligence materials, and which we have a $20,000, verification of their prior track record. And then they asked me for the background check that had private equity done. And they wanted they wanted everything. And I'm going to end up in several calls. I'm getting sharper as a sponsor, because there are somebody's finally actually going through all the stuff I pay for. I actually felt gratified, grateful. And I felt so gratified by the fact that somebody is actually caring and participating to that level. You got to be respectful. You got to be appreciative of their time. You got to be respectful, because you can't do that every single time. And if I have, hey, look, I just answered all these questions, or I have this due diligence, can you read through it? And then we'll answer your questions. If you can be, but I think all of those questions, I actually feel better about winning those investors in the long run. Right. And it can be tough, as Jillian's saying, she exited a crowdfunding. That doesn't work if they're only putting $5K or $7K in a deal and you've got thousands of investors. Right. But if you have higher minimums, 100,000, $250,000 are our average, and that we can actually spend that time with investors. And I appreciate that. Sorry, go ahead, guys. It's your show. I'm just jumping in.
Well, and there's got to be a balance, right? You're not going to get grilled over a $25,000 investment that takes you 6 months to close. There's got to be some sort of balance. And the questions are also going to tell the operator about the level of sophistication of the investor. And it has to, like Seth said, it's got to be alignment, not just in, having the operator's interest align with the investor's interest, but how do we communicate? Are we on the same page of how we communicate? How do you want information? What kind of information do you need? Am I going to get pissed off every time you call me? Maybe I don't take your money then. Right? So there's got to be alignment there too. All
right, Julian, your favorite, the operating agreement. They say that the PPM explains the deal and the operating agreement controls the deal. And I think that's really where you were coming in. What are the most important sections? You got the distributions, the waterfall, the manager authority. You got things in there that I've seen. It's impossible to ever get the manager out. That's been a red flag for me before. Transfers, redemptions, lockups. I actually been through that. And there's questions in the chat. There's several questions in the chat. One of them is about capital calls, and I actually reversed my stance on these. I've been in a bunch of deals where capital calls are not mandatory, and it put them in the sponsors a really tough spot, right? And capital calls to risk everybody's capital and have a really tough time voting in the ability to change it to try and make a capital call mandatory, to try and figure out how to save a deal. So I'd love to hear let's talk about the operating agreement. What's the most important area? I mean, that's Bill's asking that question. Jill is asking about capital calls. What are the most important areas of the operating agreement? And what do you guys think these passive investors should focus in that document? Jillian, go ahead.
I'm going to kick it to the two practicing attorneys, but before I do, when I was practicing, I always, well, not always, but I would ask my clients, do you want to make the capital calls punitive? And what I meant by that was, if there is a capital call and somebody doesn't step up to their obligation to maintain their interest, then they essentially get punished, which means that it's like a 1 to 1.2 or something, like the ratio of how they get diluted is much greater because they didn't participate. So that was my solution to that problem. And not every sponsor wanted to do that, but I always made that offer.
It's smart because it's come up a lot more lately than people would like to admit. I saw somebody ask how multifamily was doing. Been a number of capital calls in the multifamily space over the last couple of years. And to your point, Patrick, a lot of our deals, it was not required. And we've started to have a lot more pointed conversations about what should be in the capital call. I love the idea of just giving the client the option, the operator the option of if you want to make it punitive or not. It might make it harder to raise money, but here's the thing: it's like getting what's a prenup. You don't think you're going to get divorced. You don't think you're going to have a capital call, but shit happens, man. So you gotta make sure that you're ready for it, and the deal's not going to just die because you wanted to make people feel warm and fuzzy in the beginning that nothing could ever go wrong.
Yep. Seth.
Yeah, I mean, not a lot to add there. I mean, from a passive investor standpoint, like that's one of the key things you're going to look at. You're going to look at what's the structure of that capital call. If you're not comfortable with a mandatory capital call, which a lot of passive investors are not, I mean, that's a no for them a lot of times. Like that's one of the first things that you should look at as an investor. Now, if you can see the other side of the coin, kind of like we talked about today, whereas, well, if it really happened, would it be almost a good thing that I have to put some money in? I don't know. It's a tough conversation to have, but that's one of the big ones to look at for sure. Certainly next up, I would say is how you get paid. Check out the waterfall, see if there's anything kind of weird in there, because the waterfall is probably where it can get a little bit quirky and the verbiage really matters. Like, is there a catch up for the sponsors in there somewhere in one of the buckets? How is the preferred return paid? Is it pari passu with all the membership classes, or does one membership class get the full preferred return paid before the next one? That makes a huge difference. That is a massive difference as to how that's paid out. So you really need to understand the economics and the waterfall and how one bucket spills into the next one.
I love it. That is, and I've actually seen lots of ones where it actually doesn't actually spell out a return of capital. You can't quite, the different classes, there's preferred classes. You don't quite understand that before. Who's in front of you? What's your order? That's a really big one. And what do they have the latitude to do? Do they have the latitude to add another if they don't finish the capital raise, like a $10 million capital raise, do they have the ability to add $6 million in preferred equity? I've seen that happen at the 11th hour right before close, and it turns out the documents gave the ability to do that. Man, I was wondering how I was ever going to get paid on the back end of that one when that happened. So I agree with that 100%, the waterfall and the order priority. Any other comments on the operating agreement? Importance. What about transfers, redemptions, lockups, manager authority?
Yeah, I would say, especially nowadays, I think you guys are seeing that too. I mean, there's a lot more funds going on right now, evergreen funds, than there used to be. I would say 5 years ago, everybody was syndicating, everybody was doing single deals, and now everybody's doing funds. Lots of them are evergreen. So, that redemption or that withdrawal, whatever you want to define it as, for the member to get out, or for you investors out there listening, for you to be able to get out, like, what does that look like? Do you have the ability to get out? Or is it required? Is it up to the discretion of the manager? Is it up to a cap per year, annually, a quarter? That can get really difficult to understand. So make sure you read that both in the PPM and then see how it's interpreted out in the operating agreement too.
Yeah, and are you taking a discount for getting out early?
Right.
Okay, and look, guys, there's a bunch of questions we're going to need to answer, but we're at 45 minutes in. We tend to lose some participation at this time, so I would like to do, at this point, that ability for you to share with everybody who you are, where you come from, what kind of product service offering you have right now. I think Bethany's out there practicing, Seth's got TribeVest, and Jillian's got a platform right now to help educate how to raise capital. I would love to hear it. There's the slide. So everybody that's listening right now, before we get to the Q&A session, take a screen capture with your phone or take a picture of this. Make sure you reach out to these individuals, get on their list. And if we don't get to your question in the Q&A, you now have no excuse, because now you can reach out directly and bug them. And and when you go to talk about, what product service offering you guys have, make sure you do it slowly. People like me listen to these the next day at like 2x speed on my morning run along the beach here. So, and say it out loud so the people that are on the move can also hear how to reach you. But go ahead, we'll go the same, I guess, same order as on the slide here. Seth, Bethany, Jillian.
Cool. Yeah. So I'm Chief Legal Officer for TribeVest. We're actually launching what we're calling the Institute for Structured Capital. It is a fund of funds program. But what we're seeing out there is a lot of you folks that are passive investors and have a network already built in, lots of doctors, dentists, engineers, folks in tech that have friends and family that are wealthy and wanting to invest alongside of you. We're seeing an opportunity for you to make a lot of money raising capital yourself, and especially when you do it through TribeVest, where TribeVest handles everything for you, from the setup to the banking account to the LLC to the offering documents to the taxes and the K1s and investor portal. It's all in one. It's really done for you. It's fund administration, it's set up, and it's really economical. The Institute for Structured Capital is a 6-week program where you can learn how to use a fund of fund, raise capital, and we won't base it on how much you raise, but you can imagine that if you raise, let's say, $1 million, you could expect to make somewhere between $100,000 to $150,000 just from fees over the lifetime of that deal. And if you think you do that, once a quarter, do that over a few years in a row, you've got a real significant business that you've built. So this is built for you to actually launch a fund of funds through TribeVest in as little as 6 weeks. So check it out, tribevest.com/ISC.
I'll tell you what, I've been following TribeVest for a very long time, and I was just so astounded at the progress you guys made when I looked just this over the last month or so. Like, you guys have truly automated and turned a SaaS and create basically a software package to automate all of the feeder fund structure, the taxes, the administration. You got the documents all figured out from a legal perspective. I mean, it's so inexpensive with your platform to do it, and so safe for feeder funds to do it. I just was surprised by how well you guys did, and we're certainly looking towards a potential partnership there, because we got a bunch of people, just like you said, high net worth guys or just normal high tech guys in Silicon Valley wanting to raise capital, know a bunch of 10 dudes and want to create a fund, but don't want to have to deal with it. So it's a little shout out for you there, Seth. Anyways, Bethany, go ahead.
I'm operating 2 law firms, Premier Law Group and Catalyst Legal Partners. And I'm really overseeing them as CEO. My core focus these days is I am the founder of REVE, R-E-V-E, the French word for dream, which is an institutional membership platform for operators, founders, investors. And it's for people who build, deploy capital, acquire, operate with intention. I've been practicing 26 years, securities and M&A law, which is where Catalyst came from. A lot of operating businesses being acquired as the real estate transactions slow down a little bit. And I am giving away the how to talk to investors and how to talk about your pitch and capital raising and things like that. And there's a link there to check out REV. There are 2 levels of REV. There's the education level. I'm learning how to do deals. I'm learning how to invest. I'm learning how to do all these things. And then there's the I've done it now. I have to figure out how to scale without selling my soul to the devil. So we've got a couple of levels in there, something in there for everyone.
Awesome. And I'm really excited about your platform too. And I'm still looking into the links you sent me. So excited to learn more about that. Bethany, Jillian.
Hi. You can find me at findmoreinvestors.com. I was supposed to say that slow. Findmoreinvestors.com.
There you go. Mm-hmm.
And what we do is we do automation for capital raising. We create a capital action plan for you that maps you for for a full year. It's a 100-page document that maps out exactly how you're going to raise capital over the next year. But what is great about that document is, even though we give it to you, what we do is we implement 80 to 90% of it for you. So it's really a done for you automation program. But what I tell our clients is we're ghosts. No one knows that we're pulling these strings in the background. You're giving us the information. We're loading it up into either AI or other tech platforms to automate communications. And all you have to do is pick up the phone. when investors call and talk to them, and then provide them with your legal documents. And right now, not just the syndication. Just to say what, piggyback on what Bethany said about how transactions are just slowing down. AI is going to take over the legal space, right? It's not long for this world. I spent just as a challenge, because somebody said, yeah, you're not going to be able to do that to me. And I was like, watch. And I created an application in a weekend that will write a Regulation D, 506B or 506C or a Regulation A for you, and then proceed to write the operating agreement that matches and the subscription agreement that matches. And then I built a platform like Cash Flow Portal or InvestNext, where your investors can go and get those documents. So, all of this is going to soon be written by AI anyhow. And you're just going to have to be able to discern which AI you guys like better.
Yeah, I agree, actually. So I started using ChatGPT Professional about a year ago to get the documents about to 90% is what my attorney says. Like, I can get them to about 90 now, 90%. And then instead of saying, hey, I'm launching this new fund, or I have this I need this new financing agreement, I load all like 10 of our last agreement, or 9 of them, because only need to do 9 attachments sometimes. And then I'll say, like, here's the last one that I did. Use this actual file, model this actual file in the font style of my attorney and how he writes things, and then cite everything, and then make it for this new deal. And I'll literally get it to like 90%. And then he'll go through it, and instead of charging me like 5 to 15 grand for a completely new offer or litigation finance or, a real estate deal set of documents, he'll charge me per hour for a handful of hours to go back and forth with me to finish it.
Yeah, I mean, it's the future. It's unfortunately, fortunately, unfortunately, it's the future. It is going to make for less mistakes, but I'm interested, Seth, Patrick, rather, that I just broke up with ChatGPT and I'm all in on Claude. Like, Claude is running on my computer right now, doing like 3 different tasks. I still have ChatGPT because it's hard. He was my boyfriend since 2021, so it's hard to break up with him. Yeah,
so I still for legal, and I have a dedicated station for Claude, right?
I do. I have a dedicated station for Claude.
The ChatGPT is safe and contained, and when it comes to like stuff that I feel like, and I also have so much history and so many projects set up for like all of my legal matters and all my other business matters. It's going to take a while to navigate over because all that history is there. But I agree. Anthropic has just a couple months ago released an entire legal framework, and simultaneously there was a crash. Like LegalZoom, a bunch of other companies like that just tanked. So it is absolutely happening, and I do agree. But I'll tell you what, I'm very familiar and very quick, and so because I have so much history and it knows my complex structures across and how I like things now, I think it's going to be really tough. And there's no easy way to move all that over, right? That's what
you can download. If you go to your settings and you go to your profile, that you can download all the data. It will send it to your email and you can upload it to Claude.
You can get an agent to go get it for you.
Yeah.
Okay. So I'll work, but I mean, all the projects I have that show all the different deals, I can like mass do it, right?
Yeah. Anyway, you can mass do it.
I agree.
And I like how you're doing it, Patrick. Like, get it 90% of the way there. The thing that AI doesn't quite have yet is judgment, right? It's really getting close, right? But it doesn't quite have judgment yet. So can you get everything? The other thing too is security. I don't want to see you putting in super confidential information on the platform. Take it off site or take it off there, put it somewhere secure, and then finish it off 10%.
Well, Claude, that's why you should move to Claude, Patrick, because Claude lives on your desktop, lives on your machine.
And you can tell it, and you've got to tell it though. You got to tell it not to use your stuff for training externally.
Well, yeah, I haven't got there yet with confidential information because I actually still don't trust any AI with anything confidential or personal, local or otherwise. There's so many different security holes. Let's get to the Q&A. This is a really cool discussion, but I told our guys we would get to this. If you guys don't mind, And Jillian, I apologize. There's a couple notes in here saying I didn't let you do your intro. I think I talked
it's
you
fine.
up on your bio, and then I was like, I don't care why you're excited to be here today.
I always find a way to talk too much. Don't worry about it.
I did ask you the first question though, so hopefully I redeemed myself a little bit. But there was some frustrating comments.
No. It was great. I was very excited to be here. So
okay. So let's try. Some of these are really specific. I apologize for that. So let's go. So Barry asks, on a personal guarantee, how can an investor prove or determine the guarantor's assets or income to back the guarantee? That's a really interesting one.
I always used to tell my clients, never personally guarantee anything. And I never wanted anybody's personal guarantee either. Like the deal should be able to stand alone. And I don't like personal guarantees. If somebody's so desperate to get you to invest, to offer you a personal guarantee, you're not a bank. What are you investing $50,000 to $100,000? They're going to pledge their house for your $50,000 or $100,000. That's what's going to make or break this. No, come on. So if somebody's offering you a personal guarantee, I would question how desperate they are.
Yeah, that's a pretty desperate move.
Sorry, and you're all welcome to talk to every question, but if you guys are pressed for time, I don't want to be respectful. We could just have one person. Don't all feel like you have to answer, but you're welcome to. Okay, go ahead. If anybody else wants to weigh in on that one, otherwise I might go on. Ben asked, do the docs show how due diligence was done and how the returns were calculated? I'm going to say yes on the first. No on the first. Actually, I don't think due diligence, like we did a huge stratified study of the last 15 years of statistical sample of like thousands of receivable documents, and like I did this huge due diligence and like analysis, and that I didn't say anything about that in the PPM operating agreement, subscription agreement, or offering memorandum. Is that common? People like list that out? I don't know, but how the returns are calculated should to some degree. But what do you guys think about that one from Ben?
I don't see it as much on the single asset. Sometimes in a fund of funds, you see it because they want to say how they added value to get those fees. So they'll say, I did diligence on the operator or whatever. I don't know, Seth, you probably could speak to that better than I could.
Yeah, I'd say it's atypical. Even at the lead sponsor level, I've seen where they share the entire data room with investors. So they'll show you like even the property due diligence, all the, you'll see the zoning report, the title commit, like you'll see everything. I'd say that's uncommon, but I do see that sometimes, and they'll advertise that as, hey, we're fully transparent. We're providing you with everything. And it's actually a pretty good place to be, because you can't come back and say, oh, well, I didn't know about, this or that, because you just closed literally everything. And most investors aren't even going to understand all those things anyways. But I would say it's uncommon, even at the fund of funds level. I mean, that's part of it, is they'll say, hey, I've done due diligence. I've negotiated this deal with the lead sponsor to get better economics, that sort of thing. But as far as kind of getting into the details, not so much.
Okay. How long is the average pitch deck? I mean, I don't know. They range from like 5 slides to 50 slides, right?
What's the sweet spot, Jillian?
Well, I mean, again, I don't like it when people pass out decks, to be honest with you. I think passing out decks loses your opportunity to make the sale and offer an opportunity to ask questions live. So I never encouraged people to give out the decks until you already gave the presentation to the investor. So I wouldn't post your deck on a website or anything like that. Again, I usually see decks that are around 20 to 25 slides. And again, you should not be talking more than 20 minutes and then have 20 minutes for questions. That's just how I try to run things. And you can do it. You can do it. You can have a compelling pitch. If you look at like public company roadshows, people who are pitching, IPOs don't talk for more than 20 minutes. So why do you need to talk more than 20 minutes about your real estate deal?
I'm an engineer and I overanalyze everything.
Yeah, but that's what the PPM's for. And you can overanalyze that all day. And I'm sorry,
Okay.
I look like I'm turning into a ghost right before your eyes. Like I clearly have my lighting set up like weird.
Okay, Okay. So that was for Sean Barry. He's still hanging out here waiting at Barry. After investing and there's a problem, what if the sponsor I integrated this one. It was in the operating agreement. Who cares what's in the pitch deck? I think I said that already. From Jill, beyond NOI and such, what is important for alternatives outside of real estate? Beyond NOI, what is important for alternatives outside of real estate? Like important like metrics to look at, I guess. That maybe Jill be a little more specific, but I mean, and if it's because there's so many different kind of deals out there.
Yeah.
You always want to look at a leverage level, whether it's loan to value or finance or collateral coverage, right? You want to look at experience of the operator, what kind of security there is. I mean, there's just a million things. Yeah. Aileen, if the pitch deck presents a 4-pack asset portfolio and also the offering memorandum, but it never closed with a 4-pack, but a 2-pack instead, is one able to get a return of their investment and back out of the deal?
Depends on what the operating agreement and PPM say. Typically, it'll say something along the lines of, we're going to try to buy all 4 of these, but we may not, right? And we're only going to spend as much as we need to spend on it. So there's probably an out, but I would check the
Didn't mean to go thumbs down there.
What's that?
It gave me a thumbs, like, I don't know if it saw my thumbs, and it gave me the thumbs down bubble.
Don't do that.
Boo, Bethany, boo.
Okay, so how's multifamily doing right now? Coming in from Yara.
It's tight. These deals, if you're investing in multifamily right now, in my opinion, and this is not an attorney opinion of any kind, this is just investing out there, just seeing lots of deals, especially through TribeVest. We see tons of deals. You got to really look at them, guys. Like, really look at that underwriting, really look at what assumptions are going on. There are certainly deals to be had. Like, some folks have access to deals that are maybe taken back by the banks, and there's a huge value add opportunity to get into those deals, and they get them at a really low basis. And if there's some opportunities there, but if they're just, buying something off of LoopNet and saying that they're going to do a light value add and add $200 a month to the rent, you need to look at it, because those deals really aren't there right now that were there 5 years ago that were really easy to execute.
Yeah, I think a lot of people that bought too many deals in 2021, though, might be selling them on sale right now.
Yep.
Yeah, I'm feeling some pain. Yeah, absolutely. I'm not immune to those market cycles in a large portfolio. Pablo, in the financial industries, FINRA, Financial Industry Regulatory Authority, prescribes how financial institutions communicate to the public about securities in a fair and balanced manner. Is there no agency that does this same function in commercial real estate? Well, if it's syndications, then the SEC, right?
Yeah, that's what we're talking about, right? All these disclosures are how you're staying exempt from having to register these securities.
And the SEC is the enforcer of those, because you're issuing securities as an issuer, so they would be the governing body looking after the LP. Right? Okay.
Yep.
So we already talked about the most important sections of the docs. We already talked about capital calls. What are typical fees? I mean, these range all over the place, but maybe we can try and take a stab at that.
Typical fees for an operator to take?
Mm-hmm.
I mean, we see a lot of times an acquisition fee, about 1% to 2%. There's no standard fees, by the way, guys. This is all, there's some typical ones that you might see, but there's nothing that says, anybody has to or cannot take. It's one of those, you tell the investors what you plan to do, and if everybody's cool with it, then you can do it. Acquisition fees, one we see a lot. Asset management fee is another one. Sometimes there's a disposition fee or refinance fee. And it depends on the type of deal. Maybe there's construction management or development fee. So it's going to depend on the type of deal in the asset class.
Mm-hmm. Maybe Jillian can help out with this one. From Jim, will you be able to provide me with the name of a firm I can use to create the offering documents? Or I would thought it said memorandum, but an offering documents, that would be more Bethany or Seth, right?
Yeah.
On the memorandum, I think, Jillian, what due diligence material should I be asking for? I think we already kind of covered that one. Greg, let me know if we didn't. As a passive investors, coming in from Marv, as a passive investor, how should I feel about punitive versus non-punitive capital calls?
Sorry, phone's ringing.
Any comments about punitive versus non-punitive capital calls?
I think Seth kind of covered that, where it's just you really need to determine if you're comfortable with there being a capital call or not before you get into it. And just seeing the other side of the coin is I think exactly what you said, Seth, which is, do we want to be here to help save the deal if it comes down to it, or I feel like you just have to be looking at both sides of the coin when you're looking at these deals.
Yep.
Yeah. Certainly be aware, though. Certainly be aware if there's a mandatory and it's punitive capital call, you just need to be aware of that going into it with eyes wide open as an investor.
There's a comment here from Hans. Should I use AI to help review the docs? 100%. 100%. I mean, I don't know if there's any other way to do it, right? I mean, these days, because you can't keep so many details in your head compared against 2 documents. And you can write, in fact, the family office, Richard Wilson, he lives on the other side of the island here. He created a whole AI for reviewing offering documents. And all it is just a pre-prompt, right? For you to put it, and it works. It's pretty interesting. I do it myself constantly. I'll just talk to ChatGPT and explain, this is what I'm trying to do and this is what I'm looking for. And can you look for discontinuities, everything that doesn't fit? And I almost always find something. There's always something. And it usually takes 2 or 3 passes of doing ChatGPT professional extended thinking for it to actually continue to, and then I'll say, hey, look, what are the little nits and gnats? That's my securities attorney is always saying, I found some nits and gnats. And it's like, there's always some issues. So I have to keep chunking through it like 4 or 5 times and it'll keep finding enough, until it finally is done. But that's, what do you guys, how do you guys use AI in your businesses right now, Seth and Bethany?
I mean, similar to Jillian, I'm working with AI to teach it how to create these documents so that we don't have to. Like, it's gonna get there, so we might as well stay in front of it, right? And we've already got some prompts that I've created in my community to get you. You can copy and paste my prompt in to get a really good, at least first draft of an independent contractor agreement or a vendor agreement. And what it does is it takes you through conditional lawyer logic of it. It'll ask the same questions that we would have asked you, and then what you get, it's not a template. It's conditional, meaning the output is going to depend on what you say, right? And AI is perfectly capable of given the framework that we would have given it anyway to do that for you. So same as Jillian, I'm using it to replace myself.
Yeah, same here. I use it to draft. I use it to draft provisions. I use it to draft entire documents. Usually not for the entire document quite yet. I do find that it's wrong a lot. And if you're not, if you're not a securities attorney, which most of you out there are not, it's hard for you to know when it's wrong. So that's the problem, is you kind of just take it as fact because it sounds right. And then later on you realize it was wrong. Whereas if, you like Bethany or Jillian read it, they would know. They're like, oh, this doesn't sound quite right. And then a good thing to ask it is, are you sure? So after it gives you an answer, say, are you sure, ? And see what it says after that.
I asked it to come back with a percentage of...
Sorry, go ahead.
Well, ask them back with a percentage of confidence and then to break down why it rated it that way. And then it'll actually tell me its logic for what it's uncertain about. That's worked for me. Go ahead, Bethany.
Sorry, Bethany.
No, it's okay. Go ahead.
I just wanted to say, I'm on AI probably 8 hours a day, and you can judge me all you want. But I have built so much stuff to replace all of my programs, software that I was paying for that I don't have to pay for anymore. I've built tons of websites. AI, the only limit to AI is your imagination. I really believe that. I've proven that by, and I'll just give you guys a non-real estate example. The house I live in right now is probably the best real estate investment I've ever made. This was a foreclosure and abandoned property in Puerto Rico. And I rehabbed the whole place, and the pool happens to be the largest private pool in all of Puerto Rico. And it's fantastic. I'll send you guys a link. You can take a look at it. So we decided to get the permits to run an event center in my backyard and serve food and stuff like that. And we did all that. And so then we decided to have Easter brunch. And I started getting nervous, okay, if we're going to have Easter brunch and the staff has to run drink orders to the bar, which is in the back, and food orders to the kitchen, which is up here, it's going to become chaos. I'm wondering if there's an app out there that exists where I don't have to buy an entire POS system. So I went to Claude Code and I asked ChatGPT. ChatGPT gave me some crappy answers. I went to Claude Code and I said, I want to be able to do this at my house. I want to be able to send an order to the kitchen. I want to send an order to the bar, and I want my servers to just use their cell phones. In literally less than 5 hours, I had an entire app built that not only did those things, but also showed the patron, the customer, a QR code so they could scan it with their phone and pay with their credit card. All in 5 hours. Something that would have cost me time and money, and I would have had to buy a system and pay a monthly fee. And I have it running free on, Railway or Netlify or something like that, and just built it in an afternoon. So AI, I know this isn't supposed to be an AI discussion, but it is gonna encompass everything. And if you guys want, we do a AI happy hour from time to time where we talk about this stuff and we can all brag about the tools that we built. And you're welcome to email me and I'll send you the information for that.
Well, really cool talk, guys and gals, today. So Ella asked if we're going to do a replay. And I think we've pretty much covered it. There's maybe some questions here. I think we already answered some about other asset classes. Guys and gals, I appreciate it. We're way past the hour. A lot of great questions, a lot of great content. I hope everybody feels, solid about this event. We got some good comments here. Guys, don't forget, we have a session coming up in a couple weeks from now. We're going to learn about the journey of two incredible people in the alternative space, Alex and Leon, who went from hedge fund managers, lost it all in 2009, and navigated their way through their trials and tribulations. We're going to hear the backstories of our new partners in the medical receivables fund. It's a fascinating conversation. I can't wait to be there. So make sure you show up on June 10th for that. And have a great evening. I know Bethany's heading out to happy hour. I probably got a couple more hours before I do that. Jillian, you're headed for late hour, I think, if you're in Puerto Rico, right?
Yeah, it's 7:17, but not that late.
All right. And Seth, you're in San Diego. I can tell, man. You look like you're from San Diego.
Timing's pretty good for me. 4:17 out here, so it's almost happy hour.
Okay. All right. Everybody have a good evening. Audience, thank you so much. This was a great event.
See y'all.
Bye.